Hello, my name is Gabriel Yami Debiri, and I am a shareholder and practice co-leader of private debt and cross-border finance at Polsinelli.
Hi, my name is Emily Phillips, and I'm an associate at Polsinelli. I work in the capital markets and commercial lending group.
So today our subject is private debt transactions. We'll be providing you an overview of this quickly growing market. As far as our learning objectives for today, we'll begin by defining what constitutes private debt. We will then move to understanding the context in which this growing asset class came to prominence. And we will differentiate private debt from other asset classes such as private equity and syndicated finance.
And then I will go over the various players that are in the private debt market, as well as discuss the chronology of a typical private debt deal.
And then we will close the subject matter of the program today by discussing and prognosticating what we believe is the future of private debt based on the information that we have today. So what is private debt? Well, private debt exists as an alternative to traditional bank financing. As opposed to traditional bank financing, lending in the private debt world is based on privately raised capital from sophisticated investors rather than on consumer deposits, which is typically what constitutes the capital base for traditional bank loans. In addition, private debt constitutes balance sheet lending, meaning the loans that lenders make in the private debt space are held on the balance sheet for the duration of the loan rather than being syndicated or sold into the secondary markets. So where do these transactions typically occur? Well, private debt market originated in the United States and in the United Kingdom and has spread through Europe generally. The majority of private debt deals currently occur either in the United States or the UK and the rest of Europe, at least for now. What Emily and I are seeing in our practice is that many deals are now being done in other parts of the world, such as Asia, specifically South Korea, Japan, and in addition, frequently in South America as well. We will touch on this fact later on in the program. How big is the private debt market? It's large and growing significantly every single year. Since 2009, where the amount of fundraising was around $20 million over the course of the year, most recently in 2017, for which the graph before you shows you, as much as nearly $100 billion was raised in the private debt market. Since the financial crisis, the amount of funds raised in the private debt market is approaching $1 trillion. Next, we're going to move on to the rise of private debt and give a brief history and description as to how this asset class came to come to such prominence in the financial markets. Private debt rose as a significant player in the financial crisis as a direct result of the global financial crisis in 2008. So as many of you will remember, we had a significant downturn beginning December 2007, and officially the recession ended in 2009, although a lot of people felt a lot of pain even after 2009. The trigger of the global financial crisis was the failure of the subprime loan market. And the failure of many of these loans acted as contagion to the rest of the financial markets, leading counterparties to lose faith and confidence in each other's ability to fulfill their obligations with the transactions that they had undertaken leading up to the financial crisis. This exposed flaws in bank balance sheets, many of which came to be seen as inadequately capitalized, as many assets had to be written down, in many cases all the way down to zero. These banks therefore became unwilling to lend to one another, let alone to corporate consumers of debt as well. Thankfully, the system was stabilized in 2008 through what was a very politically unpopular bailout. $115 billion from the US Treasury was directly infused into the banks in an effort to stabilize and staunch the bleeding. Still, in 2009, bank lending from the largest four banks, that is Bank of America, JP Morgan Chase, Citi, and Wells Fargo, decreased still by 15% during this period. So what effect did the Great Recession have on businesses? Well, Main Street suffered tremendously as a result of the downturn. Businesses and consumers suffered losses, spent money, and as a result, businesses' returns and forecast results were significantly and adversely impacted. This exacerbated the economic downturn during this period. Over this period of time, 2.5 million businesses closed and 8 million Americans lost their jobs. In addition, and more tied to the reason why private debt has emerged as a significant asset class, banks significantly increased their lending standards, resulting in fewer loans available to corporate borrowers. In reaction to the inadequate capital reserves that many banks had, you had new regulations that came to the fore in the United States in the form of the Dodd-Frank Act, and in Europe through the Basel III Accord. What was common between both of these forms of regulation is that the capital requirements that banks needed to be different, of higher quality, and to a greater amount. Now, so you have a scenario now where you have startups, mid-market borrowers, and distressed companies all in dire need of capital. Banks are no longer lending in this environment. They're not trusting one another to lend to, let alone corporate borrowers. And as a result of the regulations, banks stopped servicing any higher risk borrower opportunities or borrowers with more complexity than what they wanted to basically take a chance on during this period of time. It was in this environment that private debt entered the scene as a sort of lender of last resort.